Welcome back, everyone, to Tax Talk Live. We're live here on YouTube, we're live on Facebook, and we're live on Instagram. And before we get started, I just want to say thank you all to each and every one of you all that tunes in each and every week, week in and week out. And a special thank you to each and every one of you who reached out the last 2 weeks, as you are loyal and faithful followers. And we really appreciate that. Now, you guys reached out to us and just inquiring about, what was going on, why we didn't have the show. And, it's been a lot of traveling here and there, didn't have internet connection so well. And then I got sick on the way back. And so now I'm back. I'm ready to go, and I'm ready to give you all this information. So let's go ahead and get right into it. What are we going to be talking about today? We have something that we've really been waiting to deliver. Like, this has really been cooking up for you all. And we're going to be talking about tax tips. So we're talking about tax tips. And when we talk about tax tips, it's something I want you all to understand, that these tax tips come directly from, you got it, the IRS. Tax tips come directly from the IRS and the IRS's website. So I want to just kind of let you know a little bit about it if you're not familiar. So tax tips are basically easy to read tax tips, and these cover a wide range of topics. And so these topics can include anything from common errors to avoid when you're preparing your tax return, where to get, free help with your tax returns, guidance on available tax deductions, which we all need guidance on those, and who's better to give us guidance than the IRS. All right. Also, how you can e-file easier, and also how you can file an extension or an amendment. So all of these things are covered and much more under the IRS's tax tips. And get this, you can also subscribe to receive the IRS's tax tips. So I want to put this up really quick on the screen, just so you can take a look at it and you're able to see it in real time, so you can see exactly what we're talking about when we're talking about our tax tips, right? So you should be able to subscribe simply by going to the IRS's website, as you all can see here. And again, it covers the things that I just mentioned, the brief points. But not only these topics, there's so many things it covers. And there are 3 key topics that we want to get into today, right? So I want to go ahead and jump into the first one when we're looking at tax tips. When we're looking at tax tips, I want to go ahead and jump into the first one. So the first tip we're going to be talking about today, it's for businesses. Businesses, the employer provided child care tax credit. That's worth a whopping $150,000, up to $150,000. So I want to go ahead and get into that, and I want to talk a little bit directly to those businesses in terms of how we actually look at making sure that you have all the information to equip yourself and prepare yourself to get this. So the employer provided child tax credit is an incentive for businesses to provide child care services to their employers, to their employees. So the first thing is you have to be a business. And the second thing is you have to provide child care services to your employees. All right. Just a little bit about the tax credit. So it helps employers to cover some costs for child care resources and referral for a qualified child care facility. And so it talks about a qualified child care facility is one that meets all laws and regulations, so on and so forth. Now, the qualified credit is up to $150,000 per year to offset 10%. Get this, it's to offset 10% of qualified childcare resource and referral costs, and 25% of qualified childcare facility costs. All right. So let's look at that for those businesses so that we can see who is actually eligible. So who's actually eligible? So to be eligible, an employer must have paid or incurred qualified childcare costs during the tax year to provide childcare services to the employees. And so when we look at that, we want to break that down. We want to get into what is the IRS actually saying. So in order for you to be eligible for the credit, quite naturally, as an employer, as a business, you must show receipts. You must show documentation where you paid or either you've incurred qualified childcare costs throughout the tax year to provide childcare services to those employees. All right. So that's big right there. Now, qualified childcare costs include. So typically when the IRS says it includes, that typically means it's including but not limited to. So it's not only limited to the ones we're about to cover, but these are the high points they want us to focus on. So costs associated with acquiring, constructing, rehabilitating, or expanding property used as the taxpayer's qualified child care facility. So very simple, very straightforward. Either you're acquiring it, you're constructing it, or you're renovating or rehabilitating it. All right. Operating expenses paid by the business, including amounts paid to support child care workers through training, scholarship programs, and providing increased compensation to employees with higher levels of child care training. So basically, operating expenses that were already, again, paid by the business. So you have to have, when you pay something, you have to have some sort of invoice, receipt, documentation, record keeping purposes so that you can validate these things, right? And so the last one is qualified resource and referral costs, which include amounts paid or incurred under a contract with the qualified child care facility to provide child care services to employees of the taxpayer. So again, if you notice in all of these, they're talking about things that require documentation. It said costs associated in the first point. It says amounts paid in the second and the third bullet point. So the IRS is looking for documentation. So if you have a business and you're providing childcare services, make sure you look into this to see if you qualify. Now, last but not least, how can you claim it? If you are a business, if you are an employer and you're actually doing this and you meet these, then you want to fill out form 8882. This is the credit for employer provided child care facilities and services. So you have to fill that out in order to claim the credit, right? So the credit is part of the general business credit, subject to the carry back and carry forward rule. Very, very important here. So this means that employers may carry back any unused credit 1 year, and then you're able to carry forward for 20 years after the year of the credit, right? So making sure that you understand carry back and carry forward. They both are different and they have different timelines on it, right? Just want to make sure we touch on that in terms of looking at our tax tips. I mean, this is really, really good information. So let's keep going. When we're talking about our tax tips, again, I said we're going to hit on 3 tax tips today. We're not going to touch on all of these, but we're going to hit on the 3 that are most relevant. So when we look at our next tax tip, all of you who may fall into the category of newlyweds, let's go ahead and look at what that looks like. All right. So the IRS is specifically talking to those who have been recently married and those newlyweds. And so summer season, basically, we're right in the middle of summer, right? Everybody's traveling. We're in the middle of summer. People are getting married, all of that good stuff. So newlyweds, you can make your tax filing easier. You can make it simplified by doing a few things now. And so a taxpayer's marital status as of December 31st. Get this. Your marital status as of the last day in the year determines your tax filing options for the year. So if you didn't get married until December, then by December 31st, your status determines even from January 1, although you weren't married. So I want you all to get that, right? Your marital status as of December 31st determines your tax filing options for the entire year. All right. But I need you all to focus in on this. This is what the IRS wants you to know. So I'm going to go ahead and give you the information real quick. So reporting a name change. So typically if you're getting married, name changes may be involved, maybe not. It just depends. But typically name changes are involved. So if you're reporting any name changes, you need to report those to the Social Security Administration, right? The name on a person's tax return must match what's on file at the Social Security Administration. If it doesn't, it could delay your tax refund. So if you're receiving a refund, you can actually delay it. So to update information, taxpayers should fill out form SS-5, application for a Social Security card. So it's available on ssa.gov or either by phone or either at your local Social Security Administration office. So making sure you take care of your name change. Also updating your address, notifying the United States Postal Service, employers, and the IRS of any address change. So you need to notify the U.S. Postal Service, your employer, and the IRS of any address change. So to officially change your mailing address with the IRS, you must complete and submit Form 8822. This is a change of address form, right? And making sure that you fill this out and you can provide all the detailed information so that your information can be updated with the IRS. All right. The next one we look at is check withholdings. So anytime your status change, it should trigger what's called a W-4. This is your employee's withholding certificate. And by the way, I want to kind of separate this really quick. You should be filling out a form W-4 every single year anyway. And we've done a very good detailed in-depth video. So if you go back and you go to our Tax Talk Live library, then you should be able to take a look at the video that we did on W-4s. It's very detailed. I'm sure you'll get some value from it. All right. So for those newlyweds or recently married, once you have a status change, then quite naturally, you want to go ahead and update your W-4 form to make sure that your withholdings have been adjusted accordingly. You don't want more being withheld than what's necessary. And so if your tax classification change, is probably changing as a result of your marital status. So going from single to married, married filing jointly is a change in your tax classification. So get that form filled out. It's going to help you a bunch, and you want to make sure that you're in the right tax bracket also. All right. So take a look at that. Also, you want to review your filing status. Married people can choose to file their federal income taxes jointly or separately each year. So you can file married, filing jointly, or married, filing separately, but you have to choose that. Now, while filing jointly is usually more beneficial, that is true. I can attest to that. That is absolutely true. You typically see more benefits, more deductions, more credits, more things that you're eligible for when you're filing jointly. So that's very, very true. But it's best to figure the tax both ways to find out which one makes sense, makes the most sense for you, which one is more advantageous for you in your situation. All right. So remember that if you're married, that if a couple has been married as of December 31, the law says they're married for the whole year for tax purposes. All right. And last but not least, we want you to be aware of scams. You should avoid any tax scams. The IRS will never contact you. Get this, they will never contact you using email, phone calls, social media, or text messages. That's not the way the IRS works. They're going to send you something in the mail, most likely. So first contact generally comes through the mail, which is written here clearly. And again, I can attest to that. So Don't fall for any scams. If somebody's reaching out to you on social media, it's not the IRS. I can promise you that. All right, so let's keep it moving and let's go ahead and touch on our last category. All right, let's touch on our last category. So, again, coming back to look at our tax tips, and this is very, very good information. I hope you all are listening to this to get some value out of it. All right, so last but not least, we're talking about hobbies or business, what most people need to know, what everyone needs to know if they have a side hustle. All right, hobbies and businesses are treated differently when it comes to filing taxes. In the eyes of the IRS, they are two different things. All right. And so you want to make sure you understand the difference and you want to understand how the two are treated. So the biggest difference between the two is that businesses operate to make a profit, while hobbies can be for pleasure or for recreation. That's the major difference. A business operates to make a profit. All right. So whether someone is having fun with the hobby or running a business, if they are paid, so if you're receiving payment for your hobby or your business through payment apps for goods or your services, then you may receive an IRS form 1099-K for those transactions, which means these payments are taxable income and they must be reported on your federal tax returns. All right, so keep that in mind. Now, how can you decide? How can taxpayers decide if it's a hobby or business? So the IRS has a list here of questions that can help you decide. I'll just touch on a few of them. We won't go through all of them, but the first one it asks is, does the time and effort they put into the activities show they intend to make a profit? So it's looking at your intentions to make a profit. Does the time and effort that you put into this activity show that you intend to make a profit? Very important. Also, can they expect to make a future profit from the appreciation of the assets used in the activity? So if you have assets involved in whatever your activity may be, can you expect to make a future profit? So again, looking at profits, IRS is asking very specific questions here. Now, do they change their methods of operation to improve profitability? So very, very important question. And then last but not least, last thing I'm going to touch on real quick is, do they carry out the activity in a business-like manner and keep complete and accurate books and records? So I want to say this, whether it's a hobby, whether it's a business, you need to keep very, very good records. Maintaining record keeping is so important. It's so vital that if you're ever running into any issues, if you're ever questioned, if you're ever audited by the IRS, those records are going to come in handy. You're going to thank yourself time and time again. So make sure you keep very, very good records. Focus on good documentation. Make that a practice. Make that a good habit of yours to follow. All right. So last but not least is a very, very important statement here. I want to highlight it here on the screen for you when it comes to talking about record keeping. All right. So whether taxpayers have a hobby or you're running a business, good record keeping throughout the year will help when you file your taxes. So the reason why they're saying that here, whether you have a hobby or run a business, is because if you receive payment for goods or services, then you're likely going to receive a 1099-K, which you have to file with your tax return, your federal tax return. All right. So just wanted to touch on that. Wanted to give you all that information really quick and give you all these tax tips. You all can, go to the IRS's website, irs.gov, and you can go to tax tips, type tax tips in the search bar, and it'll pull up the same information for you. So I want you all to be able to get this information. I want you all to be able to use it so that it can be very beneficial to you and your situation. So these are just the current tax tips that we wanted to cover today. And so we want to go ahead now and open it up for any questions that you all may have at this time about any of the tax tips. So any questions or any comments that you all may have, feel free to go ahead and drop those in the comment section. And while we're queuing that up, I want to go ahead and take this time to talk to you all about Frugal Millionaires Premium. Frugal Millionaires Premium, that's our premium product where we give you dedicated attention in a group setting as well as in a one-on-one setting. We give you that attention so that we can focus on your needs, whether that's starting a business, whether that's understanding your individual taxes, whether that's understanding your income, whether that's understanding your paycheck, whether that's your business tax situation, whatever it may be that you need assistance with, we're here to provide that service for you. So I'm going to ask the team to go ahead and drop that link here so that you all may be able to take a look at that and see if it's a fit for you, just where you're at in your journey. So another thing that we really focus on is we have 7 steps of financial freedom. And so we walk you through those 7 steps from start to finish. And each and every one that I've talked to have greatly benefited from that. And these are the 7 steps that I personally use on my financial journey to freedom. So wanted to go ahead and plug that information while you all may be getting those questions queued up. Right now, we're going to go ahead and drop that link for you all just to be able to check that out. All right, we're just waiting to see if there's any questions or any comments. If you don't have a question or comment, at least let me know where you're tuning in from. At least drop the name of your city or your state and let me know where you're tuning in from. So there's one question here that says, if you are married, can you file as head of household? So marriage, typically, you want to stay within 2 categories. You want to typically stay between married filing separately or married filing jointly. Now, there are other statuses that you can file. Yes, you can. Now, the reason why I don't want to recommend that is because it's not as advantageous for you. You're going to get the most benefits. You're going to get the most deductions. You're going to get the most credits when you're filing married and jointly. When you start to file married or separately or head of household or other statuses, then you start to dilute or you start to lose some of your benefits. So very good question. You can, but what I want to recommend is that you either focus on filing married jointly or either married filing separately. Very good question. Any more questions? We want to queue those up really quick before we conclude. All right. Looks like we have Arkansas in the building. Thank you all for tuning in this week. Glad to be back with you all. I mean, it just feels great to be back, to be home, to be back in this space, to be giving you all this information. So thanks for tuning in from wherever you tuned in from, especially to Arkansas. We did see you drop that in the comment section. So thank you all so much. And come back next week. We'll be here in the same place, 8 a.m. Eastern Standard Time, each and every Saturday here on YouTube, Instagram, and Facebook. So thank you all, and we'll see you in the next one.